Hi guys, Mike Flores here, co-founder of Trade Prosper. Welcome to Section 5, Video 2. So what we're going to do now is expand on the Donchian channels. And what you see here on the screen is a picture of baby turtles. Now the reason why I have baby turtles in that picture is in the early 1980s, there was a notorious group of traders called the Turtles who used a slightly modified version of Donchian's channel breakout system to make millions of dollars back then, and billions of dollars to this day for those who went on to run their own trading funds. Now, why was this group called the Turtles? Well, basically, it was the brainchild of Richard Dennis and William Eckert, two very successful traders who were both interviewed in the famous Market Wizards book series. If you guys haven't read Market Wizards, once again, you should pick it up right away. Now, Richard Dennis, he named the group the Turtles after returning from a trip in Singapore where he saw people growing baby turtles in a bucket on a farm. That's at least why they say they were called that. No one really knows for sure. Now, Richard believed that trading could be taught to anyone of slight intelligence. His partner, William Eckert, he was not quite as sure. So the two men went on to teach the turtles a couple of trading systems that they would use to test their theory. Now, there's much speculation that the premise for the movie by Eddie Murphy and Dan Aykroyd called Trading Places is based on the turtles' experiment. Now, there's no real evidence of this. However, the stories are very, very close. If you haven't seen Trading Places, it's a classic comedy featuring Dan Aykroyd and Eddie Murphy. And the end of the movie is where the bulk of the action is that happens regarding the trading markets. I highly recommend you check it out. The main difference from Donchian's original channel breakout system and the system that Richard Dennis and William Eckert taught the Turtles was that they used a 55-day high, not just a 20-day high like Donchian. So let's add that to the charts before we continue. So like before, I'll go up to the wrench. I'll click on Add Indicator, and then I'm going to choose 55 channel. Then I'm going to hit the X button. Now, just like before, the 55 channel is not standard. You will find in the supplemental content section how to add the 55 channel to your Pro Real-Time platform. Now, before I go on to more about why we want to use the 55-day channel, I want to talk about what it's supposed to do. Now, this technique is supposed to catch the bulk of most of the trends. Now, it'll produce fewer trades, which is cool if you don't have a lot of time. It's going to lower commission costs, which are minor anyway. And most importantly, it saves you time from having to sit in front of the computer screen all day watching your position. Now, what is this technique not? It is not meant to catch tops and bottoms. It's a trend following technique. So what you want to do is you want to catch a nice chunk of the trend, whichever direction it moves, up or down. Leave the Wall Street traders and the Wall Street economists and technical analysts, leave it up to them to try to pick tops and bottoms. We just want to make money. Okay, so using the 55-day entries, you're going to have fewer entry signals, and as a result, you're going to have fewer false breakouts compared to the 20-day system. However, this also means that if the trend is real, you will get in later than the 20-day Donchian original system. So let's talk about how we're going to use the 55 20-day channel breakout system. But first off, again, I want to make sure you understand what this means. So this black line represents the 55-day high, which means the high price of the market for the last 55 days of trading. And the red line means the high price of the market for the last 20 days of trading. On the opposite side, this bottom line represents the 55-day low for the last 55 days of trading, and this red line represents the 20-day low of the last 20 days of trading. Now, what's really cool about Pro Real-Time is as you click on the line, you see that it lays it all out for you. To the left of the cursor, you'll see 55-day high. Below that, 20-day high. Below that, the bars information. And then below that, you see 55-day low and 20-day low. So it's all laid out for you. It's not really hard to figure out where the actual levels are really at. That's going to be really helpful as we move on. So from now on, when you see the black line, you're going to know that that represents the 55-day high and the 55-day low. When you see the red line, you know that's going to be the 20-day high and the 20-day low. And at some times, you'll see that they overlap, and you'll only see the black line, like here. That's because they both overlap. And then you see here the 20-day changes. All right. This is the E-mini NASDAQ 100 futures. And now that we see how the lines are going to show up on the chart, let's get into some of the rules that we will use. So our entry method will be the same regardless what market we're trading, whether we're trading futures, CFDs, Forex, stocks, or ETFs. So rule number 1, we will start to look for what we call a sideways setup. We will call a sideways setup when we have the price of the instrument below a horizontal 55-day channel line for at least 1 week of trading or more. The more days, the better. So let's look on the chart and see an example for the long entry first. Remember, we need a minimum of 5 trading days, which is 1 week. More days is better because when the price action does finally break through, it tends to be a stronger trend. So let's look at the market. So remember, we're looking for a horizontal line of 5 days before we can get long. So here we have this horizontal line, and it's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 days of horizontal lines. So this means that after the 5th day, 1, 2, 3, 4, 5, we could now start putting in orders to get long on a break of this high. So in this case, 1, 2, 3, 4, 5, after this day, we would start looking to get long on a break of the 55-day high, which you could see to the right is 2,727. So we trade along a couple days and it doesn't break. And then on this day, it does break. So you would get long on a break of this high at 2,727. Now let's look again for another sideways setup. So here, notice we have a horizontal line. It's been broken a little right there, so that negates it. But the next day we have another flat one. So we have 1, 2, 3, 4, and then it breaks. So no trade because you wouldn't place an order. You don't have 5 days. Now we have another horizontal line starting. We have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 before it breaks. So here, after the 5th day, you would then set an order to buy on a break of this high at 274475. And as we keep going, we see here goes another sideways setup. We have 1, 2, 3, 4, 5. So after this 5th day, you would set an order to buy on a break of this high. And that doesn't happen for another couple weeks where it breaks over here. And then so on and so forth. Here we have 1, 2, 3, 4, 5, 6, and then it breaks. This one is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 days, and then it breaks. This day doesn't have any sideways, no sideways, no sideways. It just goes up. Now here we have another new high, and it starts going sideways. So after the 5th day of going sideways, we start to put in our orders to buy on a break of the high. So now our new order is going to be to buy on a break of 3016. Notice here we go a couple weeks, even a couple months, and then it finally breaks. And then it goes up here. We look for the next 5 days setup. There goes another 5 day, and then you can get long there again. Okay, so I showed you how to enter on the long side. Now let's look for a sideways setup on the short side. So before you get short using the 55-day channel, you want to have 5 days or more of the price going horizontal. Again, the black line, the 55-day line, going horizontal. So as we look here, we see that this horizontal line is way more than 5 days. And notice how here the market's going up, so there's nothing to look at. But once it starts coming down, we start looking to say, oh wow, okay, the market's coming down a bit now. Let's start paying attention to this because it might break lower. So we have more than 5 days, so we put in an order to sell on a break of 1.0108, which you can see to the left of the cursor. As the market breaks down, you now get short. You're now looking for a sideways setup. 1, 2, 3, 4, 5. So here goes another valid entry point. You can get short here. Here goes another long sideways setup. You would get short on this day here as it broke down just so slightly. This day's low was 0.9977. The next sideways setup is here. 1, 2, 3, 4, 5, 6, 7, and then it breaks lower. Here goes another one. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. On this 14th day, it breaks lower. So there's another entry there, and so on and so forth. So whenever you see these horizontal lines, you're looking for 5 days or more, which is 1 trading week or more, before you can enter a short position. And for the long, it's the opposite. 5 days or more before you can enter a long position. Now, I'm going to show you a few more examples of how to enter and exit this as we go along in the next videos. So next, what I'm going to do in the next video is add a filter to our entry. Now, the reason for the filter is to ensure that we catch the major move. We don't want to have any fake entries, or we want to limit the amount of fake entries that we get. So see you guys in the next video where we'll talk more about adding a filter to help us make money.